The S&P is up nearly 10% through May, and what history says happens next may just surprise you. Welcome to the View from the Ranch. My name is Greg Pacitti, and I'm here with my Chief Investment Officer, good buddy, and
lifeguard. Get out of the water. Hello, Greg.
All right. Summer is here, I guess.
Yep.
Huh?
Got to celebrate June. Everybody's out of school. Everybody's going to the beach, having fun. Let's practice safety, though. First time, feet first. Make sure you wait 30 minutes after you eat before you go in the water. And you see any odd-shaped fins sticking out of the water that are scary looking, get out as quick as possible.
Great advice as always.
Yes. So this month we are a lifeguard.
Every month something different.
Yes.
And definitely appreciate that. We got a great episode, big episode today. A lot of stuff going on. Like I said, the markets are at all-time highs. Earnings have been on fire, still dealing with higher inflation, still dealing with the Middle East, but also some big IPOs coming out. But the market seems to just be shrugging it off. So last time we met, you said don't sell in May. And I think that you were proven right.
Yeah, but I did not expect nearly this type of rally that we had for the month. I mean, it was
5%, right?
And the NASDAQ was even stronger. But coming out of a big bounce in April where we used up a lot of energy, it was good to see continued follow through. Usually when we have those types of jumps, even though we were down in March pretty hard, those moves that we have secondarily or the second month can be flat at times, but I'll take strength any day of the week. So yeah. Very good to see, very good follow through. And we ended the month with things broadening out. I mean, the equal weighted S&P 500 made a new all-time high. Usually you're not running into troubles when the equal weighted index is at a high. So
which is a lot different from last year, right? Is, the Mag 7 really was going up, or everything else was either flat or just barely making money, and
lots of participation, which is good. Yeah.
And we call that breadth, right?
Correct.
Okay.
Correct. And normally, we go back in our data on breadth to 1960. So
well, what is breadth first? I mean,
we talk about it all the time, but it's just the number of stocks, advancing stocks on the New York Stock Exchange minus the declining stocks on the New York Stock Exchange in any given day. And that's added to the previous day's total. So you get this cumulative breadth that can place, shine a light on accumulation or distribution within the market. When we're at new highs, like we have been, made another new high in the middle of, in May, you're not running into too much trouble. The troubles that we have, like we've said before, is when breadth draws down, when it's much weaker, yet the market keeps going. The tech bubble is a perfect example. Breadth was negative for almost a year and a half before the S&P finally rolled over.
Okay.
So right now we have a lot of participation. Everything looks on the surface to be pretty solid. So just looking at historical data, when we look at cumulative breadth through the month of May, going back to 1960, when we're up at these levels, which we were around 9,000 or so cumulative for 2026, the market almost always ends the year positive. I think there was 2 cases that it hasn't out of 25 years, and 2001, 2002. So 2001 we had September 11th. 2002 we had what we call a double dip recession. I think from the fallout of September 11th, as well as some other abnormalities with the tech bubble and accounting irregularities. But again, it's a data point that doesn't mean we're going to do well the rest of the year. Historically, it means that we're going to do pretty well the rest of the year.
So you have that indicator, which you rely on. You've been studying it for years. You found it's useful. But also there's another finding that we talked about, that when the market is up over 9% through May, what typically happens for the rest of the year, second half of the year? What did you find?
It's always positive.
Always
positive.
Since when?
1970.
Okay.
I think there might have been one year, it might have been 1987 when we had the crash. We had a down second half, but the year still finished up. And then most of the time, the years are averaging, I think, around 18, 19%. So
for the full year.
For the full year. So we should, again, expect to see a halfway decent second half of the year, unless something comes up.
That would be like a complete outlier.
Well,
because it hasn't happened.
Yeah.
As far as it could be a little less than where it is. I think you said that happened 3 times out of 16. 13 out of the 16 years, the second half was averaging like 8%, I guess.
Correct.
And so that turned into even more double-digit returns.
The main thing is you need to find out what that, kind of brainstorm what that problem's going to be. I mean, you look at the stuff that's been thrown at the market the last couple of years between tariffs, wars, inflation, a hyperactive Fed. Unless we get a hyperactive Fed, or there's something that comes out of left field, like you could say 1987 was to that point. Although if we were back then and looked at this data now, it would be pretty obvious that there were some issues that were arising underneath the surface.
Like Iran's still kind of a wild card. I mean, it seems like we're coming to conclusion of it, but you just never know. And headlines, we know you can't trust them. And
the only thing that would scare me that would come out of left field is that if the AI data center trade just suddenly blew up, and all spending just stopped. We know that's not going to happen, but that's been such a driver of the market the last couple of years that if that just suddenly stopped, we would have an issue.
Yes, right.
But in our opinion, that's not going to happen anytime soon.
And this has really been a story about earnings. So tell us about first quarter earnings. What did you see there? What kind of trends are you?
Well, I mean, the earnings we saw this past quarter is the best we've seen since, around COVID.
Really?
And there was a lot of...
After COVID?
There's a lot of comparisons there that were really easy. Sales across the board were up 11% in all sectors. Earnings per share growth was, I think, up around 12% quarter over quarter, which was close to a record. And also we've seen the highest number of positive earnings revisions, meaning that the expectations for earnings going forward based on this quarter is the highest in history. Now that often leads, we get these high readings that often leads to maybe a potential slowdown in the acceleration of earnings or acceleration of growth, but it's still above trend.
Is that all from like AI spending, do you think? Is it...
No, I think there's certain areas of the market, like we've talked about, like, in the staples sector that are struggling. But for the most part, there's a lot more spending that's taking place than what people would expect based on the belief of where we are in this business cycle. AI helps. The data centers are obviously driving a lot of technology, hardware, some of the industrials. It's helping out the energy sector. But there's a number of areas within the market that are seeing earnings grow exceptionally well.
And maybe people are also becoming more efficient, utilizing the AI tools that are out there, starting to get accustomed to it. I know we're doing that in our office as well. It's making things more efficient, lowering costs. So imagine that on a grander scale of these large corporations, that it's really benefiting them.
Now, it remains to be seen that as we get later in the summer and these benefits for the tax year from the changes from the big, beautiful bill, if the spending of tax refunds has obviously helped out the past couple of months, if that actually disappears at some point in time, which, we'll need something to pick that back up. So that's where the whole idea of keeping inflation under control and making sure that costs don't run away too fast is important to keep the economy rolling.
Yeah, and we did have a 3-year high in the inflation numbers. Everybody expected the Fed to cut rates this year twice. That seems to be off the table. What's your thoughts on where interest rates are? And then there's a new Fed meeting, a new Fed chairman that's going to be heading.
Just be happy that Chairman Powell is no longer in.
You're no friend of Powell, huh?
I think he had some good things early on, but his last 5 or 6 years, it's really been.
How many years was he chairman?
Is it 8 years?
Is it?
Maybe longer than that.
Yeah. Oh, wow. Time flies.
Yeah, he misjudged the economy in 2018 with reducing quantitative easing and then starting quantitative tightening at too large of a scale, which caused a lot of problems. The debacle with inflation in 2021, when inflation numbers were up around 9% year over year. Now we're talking 3%. Back then it was 9%, yet the Fed kept rates at zero and they kept their stimulus program going at $125 billion per month. So there was all this talk about transitory inflation, yet the Fed's still sitting there, putting wood on the fire. We have a new Fed chair, a lot of work to do.
Any thoughts on him? Do you know much about him yet?
He says he's going to be, middle of the road. We'll see. We'll see if that happens, which again, we don't need the Fed. We can have people there can help out, but we talked before about using the 2-year treasury to peg the Fed rate. So wherever the 2-year treasury is at, that's where the Fed rate is. That would keep all these booms and busts from happening on such scale as they do. And we could get rid of some of these Fed people. But
right now, the 2-year treasury yield is higher than where the
correct. So if people remember, most of the last 2 years we've been saying, they need to cut, because the Fed rate was well above the 2-year. Now the Fed rate's 3.5 to 3.75, and the 2 years close to 4, based on the moves that we've seen in yields the last 2 months. So, I mean, it's pretty close to neutral. But if we were going to be a nitpicker, it would be the case where the Fed should be leaning to raise rates just based off that standard. Again, you have a group of very intelligent people trying to make very exact decisions in a business that's anything but exact, and that's where the problem is.
The economic machine.
Yeah, and you go back to 2021, they're talking about transitory inflation and still helping out. You have to remember that there's still a lot of states that were shut down from COVID. The decisions aren't easy. That's why if they had something that was more systematic, it would take a lot of guesswork out of it. But so I don't, we got a big Fed meeting in June coming up in a couple weeks. The June meeting's always one that causes some issues. It seems like you go back to 2013. That's where they started talking about tapering, which, flipped the fixed income market upside down going into 2014. 2022, we had just started to raise rates, and then they raised rates again, but it was a very large 0.75%, which was the first time they have raised that much in decades. So it'll be interesting, since it's the new chair's first meeting, as well as some of the pressures we've seen the last couple of months with inflation, how things are approached. And you would expect the new chair to probably put his foot in his mouth the first meeting.
Yeah,
just seems to be par for the course from Yellen in her first meeting and then Powell in his first meeting. But
we're still dealing with high oil prices, and so that's got to be a huge factor in it. What's your thoughts on oil?
Oil's not up as much as it was when this conflict started. It's still very well elevated, much higher than what anybody would want. The fear of higher oil prices seems to really be just that, fear. We have to, some point in time, get figured out in Iran, whatever we're going to figure out. We have a blockade. They don't want to let anybody through. Countries like the U.S. are traditionally fine because we're oil, we're energy independent. We can produce enough oil. The rest of the world can't. So strategic reserves, even here in the country, have been getting run down pretty hard and pretty fast. So there's come a breaking point where some form of solution's got to take place. There's been a lot of talk the past week or so, even from the heads of some of the larger oil companies, about how far down reserves are and how this is going to cause a big blow up in prices because you've got to refill everything. That's not showing up yet. Maybe it does, but when we look at the current price of crude or Brent compared to where the future prices are, if there's going to be big problems, you would expect to see those future prices much higher than where they are now.
So the expectation is just short term from where the smart money is.
If I look at like June oil futures versus December 2026 oil futures, December's contracts are still down by like 30%. So if we're $100, December's futures are still trading around 70. You would think if there was going to be a longer term problem here, we would see that get drawn out. Now, sure, it can drawn out and raise those values over time, but the amount of fear that's out there, you would expect that to be those contracts to be priced higher currently. And we also do look at the commitment of traders, which, we look at where the big money traders, commercial traders are set up on oil futures versus where speculators, both large and small, are currently set up in their future holdings. And commercials remain at a very large net short position in oil. And 95% of the time, commercials end up being right.
Okay.
So it may take a while, but they should end up being right at some point in time.
Okay.
So we just need to get the conflict over. And then once things start flowing again, I think that's when we really move into the golden age of oil, because United Arab Emirates left OPEC. They're allowed to now produce as much as they can. The U.S. can produce as much as they can. Venezuela under new leader, a new government, and coming out of a very, depressed financial situation, economy. Mm-hmm. I would expect them to explore some process of leaving OPEC as well, so that they can pump as much as possible, to bring wealth back into the country. If we can start to break that OPEC cartel even slightly and increase production, it's going to do wonders for the price of oil.
Which would coincide with setting up for a really good second half of the year if all that happens.
I don't think that's going to happen that soon.
Okay.
I think the second half will probably be somewhat choppy for a couple of months. It's just the fact we got to get through really September, maybe a couple weeks in October, before that midterm cycle really flips and gets to be the most bullish part of the calendar.
We got some big IPOs coming out. 3 of the largest combined IPOs ever, right? Yep. Trillions of dollars. I think 3 children, trillion.
3 children, everybody.
3 trillion.
Do not drink and then go in the water, Greg.
That's good advice. So we got OpenAI, Anthropic, and then SpaceX coming out, which is everybody's starting to talk about. What does that mean for the markets? What's your take on it? We're starting to get people asking, can they get in? Should they buy funds that own it? I mean, it's starting to get this like fear of missing out kind of thing. What's your overall advice for someone wanting to get into an IPO? They're not the easiest things to get into. If you're able to get into it, let us know, if you're participating in that. But overall with IPOs, what's your take? And then this specific IPO, these 3, like, what do you think that could do to the markets? Is it a bullish thing? Is it a bearish thing? What's your thoughts?
In most cases, is if the overall market's bullish, or let's just say not bearish, you can buy an IPO when it comes out, and you traditionally you want to hold it for 2 or 3 months. And then
if you're get in before it comes out, right?
Oh, if you get in before it comes out, then it depends on what your lockup is. It's extremely hard anymore to get exposure to the offerings. Now, SpaceX is going to be different. They are issuing more shares. They're going to be more structured for retail investors, meaning that the company is forcing the book runners to provide shares to more retail instead of just hoarding it, give it to their institutional clients, much in the same way that Facebook did back in 2012. If you can get in, it just depends where the price is. It's the chances of anybody getting into any, even though we have indications out there, the chances of anybody getting into these is slim to none probably, but it's worth trying. Buying them once they come to the market depends on the overall market, whether it's bullish or bearish, the number of stocks that have been issued and the number of stocks that have been floated, the number of stocks that are actually on the market that can be traded. So we use the story of GoPro a lot, where in 2013 it came to the market. I don't know how many thousands, million shares that they generated, but they only put 10% of the total amount of shares out on the market. 90% was locked up with insiders. So hot IPO, you have got such a small float, those shares get traded back and forth all day long. So in the case of GoPro, which came out around 30, the stock got up to almost 100 after 2.5 months or so. Then most IPOs have a 180-day lockup, which means insiders cannot sell for 180 days. So as you get closer to that 6-month period, price will start to fall in anticipation of the price coming down, because when the lockup expires, that 10% of stock that was on the market, it just becomes massively dilutive, because there's millions upon millions of shares that are now free to trade. And all the insiders that got the stock at, pennies, they don't care really what the price is. They're going to sell and cash in. Yeah. So a good time to buy actually is after the IPO lockup. But it all depends on how much, the structure of the IPO and how much is in the float and, other different caveats.
Where did GoPro go to?
Like $1. Yeah, it's $1 now. So most IPOs I think are pretty well worthless.
Yeah, the insiders, just cashing out.
Yeah, just like the SPACs that we dealt with in 2021, the special acquisitions. I mean, that made it, those were only developed so that the insiders could sell right away. But with these three, I mean, we're looking at, if you combine these three potential IPOs in market cap compared to the three largest IPOs that we've had in the on the U.S. exchanges, which were Alibaba, Facebook, and Uber, they are going to dwarf those three previous IPOs. I mean, like $3 trillion worth of market cap. It's a massive amount. So overall, it should be halfway decent for the market, but I would assume that with some fast money moving around, that it would probably steal a little thunder from the tech space, really, because you're going to be trading out of certain tech names to get into more tech names. So.
Okay. Now, didn't they change the lockup period now all of a sudden?
There's certain characteristics, there's certain legal terms that you can sometimes change. I haven't looked at the entire SpaceX offering just yet, but there's certain ways that you can sell early. I just think the minimum amount of time that something IPO has to be held on a special basis is 90 days.
Okay.
So it's good business if you can get into them.
Yeah.
The problem is for ordinary investors being able to get into them.
Yeah. Don't be the guy that buys it at the very top and while everybody else is cashing out. So
well, if you think about
be cautious of it.
Facebook, they offered a lot more shares and they wanted to get retail investors in. So everybody was, it's the greatest IPO ever. And then the stock tanked on the offering. And I think it came out at 45 and was trading down to 37 at some point that day. Eventually went down to like 28 or 29 over the next couple of weeks before it, finally turned around and took off. So it's going to be really interesting. It's going to be really, really interesting, especially SpaceX has a lot going for it they got the space portion of it. I think what interests us a lot is Starlink. It kind of takes away. Eventually, it's going to start taking away cell phone towers. The connectivity there is basically global. And then there's an AI component to it as well. So it's a very interesting and diverse company. And I don't think Musk would have taken it public unless he thought that AI portion of it had substantial gains to be made.
So just be careful with these IPOs. My advice would be just, if you're going to put X amount of dollars in it, do it in thirds. Drip into it. It's going to be all over the place. These companies will be around for a while.
Again, most of them don't work out.
Yeah.
The
odds are against you
monsters.
as the retail investor. Just be aware of that and try not to get caught up in the hype of it, because that's how most of the time you lose money that way. Unless you can just hold on to it for 20 years. But a lot of people, if they see it drop substantially, they just panic and sell. And so just do it in pieces. That would be my best advice. If you have to get some, just get a little bit and then just keep buying in over time. Dollar cost averaging is always a great way to build a position in something. We're big believers in that. You don't got to go all in. Same when selling is when we decide to sell something. Sometimes we'll sell an entire position, but other times we'll just sell a little bit at a time. That way you're spreading out the risk of being wrong or quite wrong. But yeah, that's going to be interesting times for these IPOs. We're big cloud users, so I'm anxious to see how Anthropic prices and comes out. I'll probably wait to buy it till a little later. I'm sure I'll feel like I'm missing out if it runs, but there's always opportunities if you're patient enough. All right, so we're heading into June. What's your call? What do you think? Well, we're in June, start of June.
June's a weird month. It used to be pretty weak. Now it's been okay. The first 2 weeks of June are two of the most active weeks on the calendar. I have a bullish, bearish kind of indicator that I use based on each day, based on its past performance in the S&P and how many times that day has been an up day or how many times it's been a down day. Maybe we have bullish or bearish signal days 2, 3, 4 times a month. June, we start out, the first 2 weeks are bounce back and forth between bullish and bearish almost every day. The first week, Monday, Tuesday are bullish, Wednesday's bearish, Thursday's bullish, Friday's historically bearish. So the first 2 weeks are a little choppy. Then we move into the second half, which really gets us to July. We talk about getting to certain areas of the market, and June over the last 25 years or so has been about getting us to July. July has become really the best performing month in the market. surprisingly. So looking at June, seeing the type of energy that we've used the last couple of months, knowing that things tend to slow down.
June 17th, Fed meeting.
We're dealing with a Fed meeting. At the same time, we don't have the earnings season amongst us now. So we don't have earnings that are going to be driving stock moves or index moves. So it's hard to say. Seasonally, we've got a weak spot that comes in June, July, August, September. Really, it's June, August, and September in a midterm year. So I don't think there's a reason, unless the fighting in Iran accelerates at a rate that causes oil to go up to the 150 area.
Or if it concludes.
Yeah, liquidity is good right now. The month kind of skews. The risk in the month kind of skews to the positive side this year. There's still a lot out there that's much more positive than negative. I just have to take into account we're extended.
We're due for a little
we don't have
consolidation.
We don't have a lot of newsworthy items that are come out that are going to cause the market to want to race. So. Flattish. I could see it up 2%. I could see it down 2% for the month. I just have a hard time making any claim on which way the market's going to roll at this point in time. The market was negative in May. We could say, okay, well, it's usually bounces back in June, but we've been so strong the last 2 months.
So maybe neutral stance.
Yeah, I wouldn't get too aggressive. I mean, we have built up some cash in some of our growth models of late.
Not in a hurry to.
No,
put that to work.
Things have got to start to present themselves. And again, the trend's not going to change much about what is working in the market. We'll go through periods like we did earlier this year where we saw a lot more of almost all the market but tech participate. And of late, tech's been the leader as far as participation goes. At some point in time, that's going to change. And we've got to have somebody else step up. Those types of periods are great, but they don't last. Sometime in the future, it will last, but for the last, decade and a half, small caps leading, it doesn't last. Mid caps leading, it doesn't last. Consumer staples leading, it doesn't last. So we go through these periods, which are healthy. Things will eventually remain the same.
Okay. So maybe just head to the beach for the month of
June.
Yeah.
I'll be out at the lifeguard,
Yes. Got your sunscreen?
Well, you got to get the zinc, got to get the bullfrog, got to make sure you're looking like David Hasselhoff.
Yes, you
the one on Baywatch, not the drunk guy eating hamburgers in his hotel room.
Well, you pulled off well.
Yes, just wait till you see what I have in July.
Oh, I think
it's 250th anniversary of the country. So,
well, that's it for View from the Ranch. Hope you learned something. Hope you enjoyed it. Drop us a comment if you're getting in on that SpaceX IPO, but also subscribe if you want to get notifications of our next podcast, video cast. We'll see you in July.